Tim, thank you so much for joining us here at Super Return International. It's great to have you.
Thank you for having me.
There's a lot of your colleagues here in Berlin, 4,000 members of the industry, and you're going to be talking specifically around trends you're seeing in terms of senior debt and the market share it's got now compared to previously. Talk to me about that and what you're seeing in this current environment.
So we are seeing a lot of share gains of middle market, direct lending, and senior debt. The catalyst for that growth in years past, last year was really the failure of the CLO market. CLO issuance was way down. So that drove a lot of share for direct lending and private credit providers, particularly in the fourth quarter. This year we've seen regional bank failures increase that market share gain, and we expect the share gains in the past and the growth in the asset class to persist in the near term.
So people see this as a bit of a safer place, a sanctuary, if you like, in this sort of fairly turbulent environment we're in.
That's right. I think the asset class has been tested across cycles. Through the GFC, it acquitted itself very well. Through COVID, we saw massive disruptions in revenue models for borrowers. And the performance of direct lending and private credit was very steady during those periods of volatility. And so I think today, with an elevated interest rate environment and the opportunity to compound at a double-digit return, the safety that you've noted is certainly a compelling risk-adjusted return for investors.
You said you could achieve the same return. Realistically, is that over a longer term, or because obviously private markets always prize themselves on having the greater return. So how does that sit in those terms?
I think the nearer term return opportunity is also incredibly compelling. We haven't seen senior debt yield 14% in the 20 years plus that I've been doing this. And so to be in that place of safety in the capital structure, whereas in years past you were looking for an 8 or a 9% all-in return, we're looking forward and seeing an opportunity to do much better than that, given that rates have risen. I think what offsets that is, again, companies' ability to cover interest. And so that is something that investors are scrutinizing more, and I think appropriately so.
With all of that in mind, are there any particular sectors that you're most interested in terms of investment at the moment that sit well with that strategy?
At Willow Tree, we're maintaining the same exposures that we've had, really focusing on quality of earnings, recession-resistant businesses in essential sectors. So we have not invested in recurring revenue technology, oil and gas, power generation, restaurants, consumer. Many of our peers do. We just don't think those businesses are well positioned against recessionary pressures. And so we're looking to just maintain the focus and discipline that we've had throughout our 7 years in business.
So batten down the hatches, but there must be something that you're feeling optimistic about that perhaps is on the horizon. Are there any opportunities out there that you're really interested in at the moment?
Well, for us, it's about de-risking.
Right.
It's about maintaining discipline. The risk-free rate is providing quite a lot of alpha for investors that can invest in companies that have a real good chance of performing in a recessionary environment. And so, again, we are not investing in companies that are exposed to volatility in commodity prices, that are not exposed to consumer price indices declining. We're looking at utility services, we're looking at financial services, insurance services, healthcare, et cetera. So those are the sectors that I think that we're most bullish on.
As I mentioned, there's 4,000 people at this conference this year. It's phenomenal. How do you enjoy that sort of environment? Is it good to be able to meet your colleagues and share insights and hear ideas?
Oh, it's fantastic. Yes, there's been so much growth in the asset class. I see peers that I've known for decades running very large businesses, and I think all benefiting from the secular tailwinds of growth that direct lending is experiencing, and I think should continue to experience.
It's great to have you here. Thank you so much for joining us.
Terrific. Thank you very much.